My first job this evening is to chair a really interesting panel with some different perspectives. So I will introduce the three panellists. I suppose my main job is to introduce them, make them blush sort of a little bit, but not too much, and then we'll get on with the show. So first up, Martina. I'll introduce all three of you, and then you come up at the end. So Martina is the former CEO of Featurespace, which was a Cambridge spin-out. It became a global leader in fraud detection and prevention and risk analytics, and it sold to Visa last year. The headline price wasn't ever announced, but we made about 7 times our money, and it was a very good exit. But what you might not know is before going into the world of fintech, Martina was in media. She was a senior leader in media, so she spent time at Yahoo Europe and at Capital Radio. So if anyone can keep us entertained while explaining behavioural analytics, then Martina's your person. She was also named GP Bullhound's Entrepreneur of the Year last week, I think. So an award winner, and she's a... And I've been told that Martina's mantra in leadership is visionary but grounded, and that's basically what I'm aiming for tonight on this panel. So visionary but grounded. So next up is Richard. Richard is the co-founder and CEO of Cytora. That was another exit for us this year. That is the yeah, indeed. Richard's business is the AI platform that is transforming the way that we do insurance risk assessment, and the acquisition was to Applied Systems. We are actually on a bit of a tight timescale because Richard is busily selling his wares into the larger Applied Systems group. So he's got to hop on a flight at leave us at 6:10 to shoot back to New York. So we're very appreciative for you joining us, and it means our panel discussion will be reasonably sharp. The two things interesting about Richard, one is he was a philosophy major at university, which he credits with being able to ask smart questions and different types of questions. So when he's growing his business, ask different questions to customers and to investors. I think that's very interesting. And another thing we should point out is, let's just say that Richard knows a thing or two about rhythm. You can see this on his LinkedIn because he's got a background in dance. So if the questions get tricky, we know he'll have the sort of speed of feet to be able to move around the questions. And then finally, on the panel, we've got Nalaka De Silva here in the front row. You are head of private solutions at Aberdeen. My notes are so out of date that Aberdeen has still not got any vowels in it. So Aberdeen, and you oversee some of the UK's largest pension fund mandates, and congratulations on the recent mandate win with Scottish Widows, which is great to see some of those early pension funds that signed up to the Mansion House Compact putting their money where their mouth is. So that's great. Richard Nalaka started his career as a chartered accountant, and then he went on to specialise in sort of cross-border M&A, and now if you hear Nalaka speak, he talks a lot about championing patient capital, which is something that is quite important in the UK. So Nalaka, you prove that patience really is a virtue, and it also helps if you've got a few £1 billion to back up your contention. So please join me in welcoming Martina, Richard and Nalaka up to the stage. This is going to be a fascinating panel, I have absolutely no doubt. So I'm going to start with, I suppose, journeys of entrepreneurship and commercialisation. So we'll start with Martina and then go on to Richard. Could you just talk a little bit about how you started your business and when you first got involved, and the role that IP Group played in that journey, and then possibly if you could weave into that a single point where you can recall that you thought, yeah, we've cracked it, we've made it. Was there a single point?
Evening, everybody. I was introduced to Featurespace by Mike Lynch, the technology entrepreneur. So I kind of owe him an awful lot, actually, and I think all of us in the UK probably do. He introduced me to his lifelong friend, Professor Bill Fitzgerald, who is a professor, head of signal processing and applied stats at Cambridge University, a fellow of Christ College. And he said he's invented this fundamental technology, but he doesn't know what to do with it. Can you go and see what you can do? So I know, well, I haven't got a clue what he's talking about, but, I'll have a go. And, of course, it was the early days of AI, And what I knew about our technology is that it needed large real-time data sets to be able to make the performance really come to life in the technology. And of course, getting access to live data in academia is really hard. But also getting access to live data when you're a company is incredibly hard as well. So the first thing we did was we imagined all the different types of AI use cases that are now prevalent in the world. And we had great fun doing that. And we actually went after quite a few of them, tried them. So we were speaking to oil companies about, could you predict the moment of time the drill bit would break? And can you, every time that they do that, it closes production, millions of dollars are lost. So that was one. I hired a data scientist who had been modelling gallbladder removal operations with a surgeon. And could we create the moment of, where robotics would actually be used to be able to... We went out, we spoke to the NHS, we spoke to surgeons, and the answer we got back was, it will never, ever take off. That will never work. Surgeons will never, ever. How many operations these days are now done without some sort of robotic assistance? Or how many of our, the analysis that's necessary is now done with the assistance of AI? We had access to skin lesion data. Could we predict the moment of change if your prior skin lesion, could you then look to be able to say, this is the moment the skin lesion has changed, and so therefore go to your doctor? I got very excited about that. I spoke to our scientists and said, I'm going to be on Radio 4. This is going to be amazing. We can cure cancer. And of course, the answer was, Martin, the false positive rates are so high. All we'll be doing is firing off false alerts and sending people to the doctor when they don't need to go. We'll be frightening people. So we can't stand behind that. And unlike a famous tech entrepreneur who's now in prison, I said, well, OK, I have to now make sure that I take your advice, which was based on my morality rather than anything else. So, just trying to work out our place in the world really did take quite some time. But it was a gentleman called Roger Alexander who introduced me to the payments industry. And he said, go and spend time there, you'll revolutionise it. So when did we hit our eureka moment was probably when we got access to... the payment industry is complicated. It has big on-prem systems. So I had come out of being, early days on the internet. Never thought it would be on-prem, but of course it ended up being that if we wanted banks as customers, we had to build to what they wanted, which was on-prem. So we then latterly went through the transformation to becoming obviously cloud native. So finding that payment data, being able to get supported by banks, by winning the confidence of banks to be able to, provide them with these systems. And I think there were two deals that we did. One was with a company called TSYS, and they processed 120 banks' payment data, and we did better than anything that they'd ever seen previously. And then when we were selected by NatWest, because my team all the way through kept on saying, well, they'll never select us. Well, the bank is never going to choose us. And I kept on saying, well, they haven't said no yet, so let's just keep going. And then at the end, they said, we've been looking for your solution. We've dreamed of it, but it has never existed until you came along. So it's that customer perspective that was so valuable to us. And then we hired experts. We hired the fraud experts from the banks to come and work for us. And that shortcut through to sales made the world of difference. So rather than having to go and invest in a huge, great big sales team, we hired people who already had all the contacts. And how about this? I learned that the anti-fraud guys, they kind of were in pockets of places in the UK to start with. One was in Northampton and the other was in Southend-on-Sea. And mostly guys of a certain age, and they all played golf together. So I hired their mate who played golf with them, and we did golf days, and then we could infiltrate their conversations that were taking place, and and build trust that way. Then we found out what was going on, and they went, "Oh yeah, okay, fine, we'll give you a go." So and it was all those experiments that led us to that. You can't design that in a strategy. You can't really talk to an investor and say this is what's going to happen. And the IP group, God bless them, had invested in Featurespace before I was there. So I don't know what it was you saw in that technology early days.
Very visionary.
And then, a particular shout out to a gentleman called John Eddington, who was the representative from the IP group, who was on the board when I joined. And he was still our IP group representative right at the end, right until the last vapours of the deal and the money being transferred. So it was so brilliant for me, because there's so many days when I sort of go, oh God, I don't know what I'm doing, and it's, are we ever going to get there? And he's such a calm guy, and he'd just say, just keep going, Martina, you will get there. So having a partner who's been there, who's had so many different companies that he's looked at, but be able to say, no, you're definitely onto something special here. Sorry, I've taken up quite a lot of that conversation.
No, it's great, yeah.
But it's
all founders pay attention to going and find someone who plays golf with your main customers is the takeaway.
It's really understanding your customer, getting under their skin, and being able to really know what it is. And we built the whole values of the company around that deep understanding of the buyer and the kind of person that they were. So we didn't make the principles were not about our technology; they were about our end target market, our end customers. I had researched it. I knew that it was a really lucrative market, and that if we pulled it off, we'd pull it off big time, and we did.
Yeah. Well done.
And Richard, you've got some interesting stories on sort of commuting to get customers a short distance periodically. I understand. So do you want to say something about the history and the Park Walk support?
It really resonates what Martina was saying. So I mean, at the beginning of Cytora, we didn't know anything, not only about what we were doing, but in general. Like, it was pretty much my first job. And but it was a very thrilling time, because, as you can imagine, when you don't have anything, you don't have much to lose. So my mum lived in Cambridge. So me and Josh, who was one of our co-founders, we just kind of lived in her house for 2 years pretty much on the Trumpton Road. We'd walk to the Judge Business School. We'd try and figure out our idea, which really was bringing together large amounts of unstructured data on the web to make predictions about risk. And early on, we kind of thought our market was geopolitical risk. So we were trying to predict all these geopolitical events, which is quite difficult to do, as you can imagine. And but it was probably the most thrilling time, because we were just exploring this idea and the contours of it, and trying to unfold it in different ways. And we weren't very commercial at all. So our first contract was 20K, and that felt like a huge deal for us. And we were lucky enough to be surrounded by lots of people who believed in us. So we met Anne, who now works at Park Walk, who invested really early on. We met Martin, who was at Park Walk, who invested. And pretty much in these moments, we were most of the time going backwards, not forwards. So we kind of thought we found a market, and we realized actually that wasn't a good market. So we had to go back to square one, and there's a lot of volatility. But at some point, we realized that insurance was a good market for us to focus on, and particularly commercial insurance. And Allianz paid, I think, around 4 million a year for our platform, and we didn't really have a platform, but they kind of believed in the vision for it. And I think, to your point, that was a kind of crucial time for us. We were like, well, this must be quite valuable if someone's going to pay 4 million for it. That it has to have some value in it. And then over time, knowing that we'd found a problem that actually warranted a solution that someone's willing to pay a lot of money for, we learned through that, obviously, what the product should be, because we had a willing customer, but also how to do enterprise sales and actually sell to large customers. And a part of this is leaving behind your origin. So obviously you can't do that from Cambridge, because everyone's like, well, what's Cambridge? Why would you be based in Cambridge? So for us, it was about being very global and trying to be global at the point we were 40 people. So for me personally, I commuted pretty much every week to New York for about 2 years. I'd go there. I would just kind of say I lived in New York. And it was, again, very, very fun, because it was a new phase. And I think one of the things that we had the benefit of is we always had a lot of belief in us as people. So we always had enough belief to push ourselves to subsequent phases of Cytora until we were acquired. But I'm sure that will continue in this next phase. And
also had a fantastic exit. I think the largest, if not the second largest, that we've ever had from our Park Walk portfolio. So it was, again, like Martina, a great sort of commercial success it was. And maybe if I turn to you, Nalaka, a little bit about UK institutional capital support. Loads has been written about this in the press. It's been talked about for the last sort of 2-3 years. Tell us a bit about how we should think about risk appetite and risk taking at the pension fund level, and what you're doing at Aberdeen to sort of push the envelope?
Yeah, it's pushing the envelope for sure. I think that's probably the way to describe it. But I think the UK, I think, has always had a very conservative asset allocation framework, and whether it's insurance companies or pension funds, and it's driven kind of a behavioural kind of way of thinking about things, and it's driven very much in the context of can we de-risk, and what's the fastest point around de-risking. And I think the world has moved on from that point when we think about what bonds and equities can do for portfolios, and when we think about private capital markets, and when we think about early stage venture in that context, or whether it be infrastructure projects. I think that narrative is now is definitely far more, I guess, prominent. I think the thing around risk taking is probably the biggest hurdle that we've got to face from a UK standpoint. I think trustees, governance bodies have to be able to prepare to understand the risks that are being taken in the space, and then become comfortable with those risks. If we look at our European or American counterparts, the Americans, I think, probably are the furthest advanced in kind of making it normalized to own venture capital in part of their portfolios, whether it's looking at private equity or anything that's sort of more risk taking in nature. So I think from our standpoint, we're really pleased to kind of be involved at the ground floor of trying to push the envelope on asset allocation to bring growth equity in a meaningful way. The challenge is, I think, it's brilliant to hear stories like this kind of coming out, but the ecosystem in the UK isn't as mature to a certain extent, and therefore we need more companies and more of an ecosystem, being successful, and people writing about it in the papers, being excited about.
But they don't. It's such a category.
Yeah.
We were on a prep call together, and we've just sold our companies, and we both have agreed that nobody in the UK is interested, right? Because we got no coverage.
And we need to change that. We need to, people need to get excited about, and
How can they?
If you start at age 20 saving money and you're retiring at age 65, the compounding that you're going to get over that time of holding, private assets, because that's the longest duration portfolio. It's even longer than the DB pension books from a DC standpoint. You should be exposed to these exciting stories. Now, there's going to be not every venture asset, delivers in the same way that you have, but we need to be in the culture of getting excited about this and being able to talk about it. And once it becomes normalized to celebrate success in this way, I think that'll change the culture a little bit around this. And then from a governmental standpoint, the rules, restrictions that are essentially incentivizing conservative risk taking, we need to look at ways of we can't be unfettered and just say, look, everyone's going to put 30% of the portfolio in venture, but at the same time it's got to be more than zero. And right now the number is very, very small. So if we can move that to 5-10% of the portfolio for private capital markets, and venture is 2-3%, that is a massive pool of capital that can be deployed. Now, it's got to be done sensibly, and I think it's in that risk-taking and understanding that risk that hopefully we have more success stories like this, and homegrown success stories.
But there's definitely something about championing it, isn't there? I mean, we're not. I think we have more coverage of companies in our portfolio that have funding difficulties or write-downs in value. The press love to pick up on, company X has had a difficult time, and so IP Group slashed its value and all that sort of. But the column inch is dedicated to, we've managed to scale a business and sell it into Visa, or we've scaled a new AI business, completely redefining how we think about insurance risk. It just as, Richard, you were saying it didn't get picked up anywhere, not even in the trade journals. It's incredible. So we do, people in this room. One of the things that we've definitely would want to get out there is this sort of advocacy for success stories and making sure that the press pick up on that. And we've had a concerted effort this year to try and get more good news stories out there. But there's definitely a sort of a bit of a risk bias on talking about the bad news and not the good news. So hopefully we can get lots more examples around that. And I was going to have a question on how easy or hard it was to raise capital. But interestingly, both Martina and Richard said with a growing business model, a successful business model and customers, although it was tiresome and challenging, it wasn't your main challenge, was it? Is that sort of fair to say? So
early stage,
yeah.
So how the kind of companies, thank God for you, because the kind of companies who've got no model that they can really show, or a product that's really found its market fit. How do you know? And that's amazing that you can do that. But most investors, it's quite easy to be able to run your slide rule over a company that's got revenue, and particularly if it's a software company that's got recurring revenue, you can, that's the beauty of software, isn't it? I mean, that's why it's worth investing in, because you've got that long tail on your revenue. You see, if you've got a contract for 5 years, if you've got a 80% margin on your contract, your underlying business model is then going to be absolutely solid as a rock. That's why we don't need to that's why you don't need to manage profit. Because if your underlying contract value is such that your cost base can be flexed, you've got a profitable business. And investors in our country get completely hung up in this whole idea of profit. And I think it's very simple to get your head into a different place. Understand ARR, understand the value of the contracts that have been closed by these companies, then you'll understand the future value. But even working with, I know I probably won't go there because I'm still under contract, but it takes time to explain to people that when you start your year in January, you've already got your year done, and you're going to have the best possible year you've ever had, as long as your churn rate is really low. So it's just such a fantastic business model, and yet it's so depressing in the UK to see that our investors don't understand it.
I think there's something on education, though. That's an important part of this journey. Is helping both, the literacy rates around sort of, I think people are getting their heads around bonds and equities now, let alone private equity or venture capital. So, I think this idea of cash flow analysis and understanding what a cash flow actually does, like we can do it with infrastructure assets. We write a big contract to the government and say we're going to put a train on it, and no one really cares about what happens to the train at that point. It's the contract and why can't we do it for contract-based, recurring revenue businesses? So I think getting people comfortable with the sort of idea about, what is it you're buying and what the actual risks are. I think that requires quite a bit of education yet.
You definitely have. I think there's this kind of excessive abstraction of companies, and you get investors saying like there should be a 2x, 3x, and all of these kind of really superficial kind of mental models of how a company should grow. And my experience is actually like often the great companies grow in a very different way. And sometimes it can take 10 years of zero revenue, and then suddenly it kind of, you think about UiPath, I think 15 years to hit 5 million ARR, and then 5 years to hit 250 million or something like that. So for me, it's almost, instead of trying to universalize everything, you should be really in the particulars of like, what makes this a very unique company? And there has to be a great idea at the core. So one of the missing aspects, I think, is just not being interested enough in actually what makes that company idiosyncratic. And often the best companies have a great idea which, on initial viewing, feels like it's completely incorrect because it's counter to everyone else's belief system. And I think we got very lucky because people believed in us when there wasn't a lot of factual evidence. But I'm sure a lot of companies die when they just don't fit the paradigm. But that's a good thing.
The example you just gave, I'm not familiar with that company. But one that I am familiar with is Blue Prism and the way that they were able to really scale their revenues. But they had a distribution model. So they relied on the big four to go and sell their technology. It was a transformation sales case. That sales pitch was the thing that transformed their company. I'd be really interested to know if the difference. I mean, there was the judging panel I was on recently. When you go to the butcher, there's that red and white tape that you can put around your meat. Well, they just sold that in the UK, and they got a new CEO, and the CEO said, well, why don't we sell this internationally? And they said, we never thought about that before. So they hired an international salesperson, and guess what? It transformed their company. So, I think that's the other thing as well. Sometimes it can be as simple as making sure you've hired the right salespeople. And again, if I may, in this country, put your hand up if you think you're in sales. Right, okay. Put your hand up if you are happy if your children go into sales. It's not good enough. It's just not good enough. We're all in sales, aren't we? We've all got to sell what we're doing on a day-to-day basis. And so therefore, unless we have really excellent salespeople that sell our products, then we don't scale. So, we did really, really well in South America. Somebody said to me the other day, what was your strategy for that? I said, we hired a really great guy who was Mexican, who was an engineer by background, and he said he wanted to build a business in LATAM. So we let him do it. And we were enormous there. So, I think that's the other thing, which is we go on so much about strategy and product market fit and all the rest of it. But unless you hire really well in sales and unless you're really on top of your sales, and to be fair again, Mike Lynch, not only did he really know the technology, but my goodness, he knew how to commercialise those two things, and that's why he was one of the most successful entrepreneur in the UK.
Yeah,
very good. So on the subject of exits, and obviously this sort of balance of it's a fantastic outcome for our stakeholders, for you, your shareholders, your employees, etc. In both cases, the technology is going to go on and proliferate into much bigger businesses. Anything particular around what might have tipped the balance for you to go the next leg of the journey as an independent business, or that would be very helpful to hear from both.
Yeah. So for us, I mean, for me personally, I always felt like the idea was more important than the company. So the idea we were chasing really was to enable risk to flow in a very frictionless way. And, the way I often say this is, the interface for money is great. If you put your card on a card machine, money flows from your bank account to another person or another business in a very seamless way. But risk as a transference is the complete opposite. It's very frictional. And it often takes weeks for a company to actually transfer a risk to a financial market. So we wanted to change that. So when we got the offer from Applied had basically got around a 70% market share on the intermediaries. So all of the agents and the brokers who intermediate the risk between the client and the insurance company. And we'd spent most of our time selling to the insurance companies and the reinsurance companies who ultimately assume and absorb the risk. So for me, it made complete sense to join forces with Applied because together we could change the whole value chain of risk. And that was really, really exciting. So I felt a lot more excited by that possibility than a, Series C growth investor investing. And to be honest, like the terms of many of those term sheets were not particularly exciting. The valuations were good, but the actual preference shares I thought would kind of, somewhat kind of confusing given we'd eliminated most risk. At that point, we had product market fit. We scaled our revenue to about 20 million in ARR. So I was just genuinely a lot more excited by joining forces and Apply. And the continuing our independence didn't really matter to me that much. So that was why we did that.
But it's interesting that you mentioned the terms. So the headline terms were quite attractive, but the press really put off the management team, and it didn't feel like sort of fair sharing of risk, which obviously for businesses in the business calculating risk is particularly
in my mind. I was like, how can it be that all of our seed investors who took the most risk like had no structure in their term sheets, and then you get to like a great business, like great margins, huge addressable market, trajectory to billions of revenue, and then so I just found that really, really hard to understand. And going to your point about risk aversion, I think it's insane, right? Because like obviously it's an institutional investor, but there's a kind of confusing kind of paradox there where you should have eliminated a risk, but you're actually getting more risk aversion.
Yeah, it's an inverse curve, which is weird. And I think it's a cost of capital issue as well, because whilst there's been two excellent exits here, there's a graveyard that didn't make it. And I think what we're trying to do is trying to work out how to calibrate that. But unless you've got a depth of market, you can't, because you're going to get these sort of crappy term sheets and you're going to have some brilliant ones. And I think until there's a fluidity of the marketplace, I could say, actually, this is what a standard term sheet looks like for a company of this nature with these characteristics. You're going to get this sort of, kind of dispersion. And I think
get that level of dispersion, won't you? Yeah.
But I do think that's why we need to support it, because if we don't, you're going to get companies that are brilliant companies that will either get sold too early to other people at the ground floor, and will probably never make it to the public markets, or they're bought by a strategic that is public already. And so I think that value creation is really important to figure out how to create the right ecosystem for that and the right depth of market, specifically around the risk taking that investors take.
Yeah.
So the only people who whinge about it being too early, selling the company too early, are public market investors. We had 640 shareholders at Featurespace. Most of them are employees and ex-employees. Even the grumpy ones kept their shares. I believe in good karma. And everybody won. Now watch those guys who left because they've now got lots of money. What are they building? They'll be the next round of entrepreneurs that we're building in the UK, and they've learned ever such a lot through the Featurespace journey. So I look at that and I just think, again, we don't talk enough about this, that makes sure that if you're building businesses, the wealth is distributed, that the top executives don't take it all, that, you really break that wealth out amongst your workforce, particularly in high IP areas. Because one of the things in the UK we all know is that we produce these fantastic scientists, and they are cheaper than most other places in the world. So how do we tie those people to us? We give them our shares, and it's beholden on us as leaders to teach them what that potential could be for them, because a lot of them didn't understand. But actually, guess what? They want to walk through a nice front door in the same way as everybody else does. So, making sure that you get that bit right is really important. And then if you can invest in companies like IP Group, they'll find us, and then they're on the public market. So, yes, Aberdeen, I think it's absolutely fantastic you're going to find great young companies and great talent to be able to invest in, because guess what? We won't go to the public market. And why won't we go to the public market? Because when you're a CEO of a company, you don't want... This is what was so wonderful about running Featurespace. I said to our investors, my job is to make sure that I win customers, because that's the way we're going to grow value in the company. And then that way, our workforce will feel motivated, and then that way, our investors will be well looked after. Companies that turn up to work every day just to keep their shareholders happy have got it the wrong way round when you're in business to business and you're selling commercials. So if you do it that way around, everybody, in theory, should win. But what happens when you go into the public market is you have to do it the other way around, and the CEO spends all their time talking to shareholders. And then it's like the chef that's built the great restaurant has to spend all their time out on the front, not necessarily in the kitchen any longer. So I think that your focus of attention on your company shifts when you move into a public market primarily, and I've sat on lots of public boards. So I do think we need a bit of a change in attitude here in the UK, and in the meantime, invest in IP Group because they'll find us.
It's a great feeling. I mean,
I would happily...
I'm not on the payroll.
No. I would happily talk all evening, but Richard, I'm very conscious of your not holding up for flight. So we've got a few government representatives here. We've got some friends from the British Business Bank, etc. Just from each of you, what one suggestion each around what the UK and particularly the government could be doing more to help create this sort of vibrant ecosystem that we want. I'll start with Nalaka and we'll move down.
Yeah, I think, the government's done a lot to try and catalyse something at the moment. Yeah. I think that shouldn't be taken for granted. I've been on committees for a long, long time, for many years, and we haven't seen this much progress in many ways. But I think there's still a lot to be done around harmonisation of the rules, because depending on which angle you're coming from, whether it be cost caps, whether it be disclosures, whether it be, it makes it very difficult to kind of get those until the rules are kind of harmonised. The second part is you've got to create the right environment for these types of companies to be successful. Silicon Valley wasn't built overnight, and neither was Cambridge, and so what we need to do is invest in the right, policy environment that allows, capital to flow effectively, mobility of labour to come through, incentives to be, taxed appropriately. All of these things will be the ecosystem as I see it. And that's not just a private sector thing. It has to be a combination of, companies working with asset management, the consultancy market and the governmental sectors. And if we can all work together on that front, I think that this is the chance that we have to actually do something that's probably hasn't been done for the best part of 50 years, is to bring a significant pool of capital into the space.
Thank you. Richard?
Yeah, I think the first thing is to probably hire better people as politicians, basically pay politicians more, because who would go into politics who would be an MP? Most of our software engineers would maybe earn double, and it's just a complete mismatch and it makes no sense in terms of a marketplace. So I think that's, if you don't fix that, you're not going to have well qualified people becoming politicians. I think the second is actually kind of kindle risk-taking habits. Mm-hmm. So try and actually get people to take risk instead of going into a consultancy, like join an early stage company. And I think that relates to thinking about incentives and tax, and also how we codify and conceptualize failure as a culture, because obviously most companies don't succeed, but that doesn't mean that if on your CV you've worked in a startup that didn't work, that should be a problem for you. And I think that's very different in the Valley, right? Because in the Valley, it's actually seen as a kind of...
Tangible.
Yeah, so I think that's a cultural thing we have to overcome And then I think diversity in government would really help. So I made a joke of it'd be great if Meryl Streep was a politician. I think you need people who are just kind of pragmatic, they're sensible, they're smart, they're creative. I think there's too much convergence in politicians today, but they're just 3 ideas.
Thank you.
Meryl Streep, yeah.
Yeah.
Let's go. So how much money do we spend in the UK on technology per year? Government spending. £29 billion. What's the lifeblood to a young company? Contracts, money, real, yes, there are loads of investors out there, but once you get going, you need your contracts, you need deals. And then when I've looked down the list of the suppliers to the British government, nearly all the money is going to the big US tech firms. So that's not very encouraging. And part of the problem is procurement. So I would change procurement in government. And the other thing I would change is access to data. Because I remember going into Number 10 a long time ago and meeting one of the policy advisors, and they said, we're giving the NHS data to Google. I was like, why? Well, because they're going to give some data scientists in return, and you just think, but our biggest asset is the data that we collect in the UK because our public services are, in my opinion, extremely good, world leading. So, but the data asset that we have there is so special, and we don't talk about how we're going to monetize that for the greater good of the taxpayer who's put that public service together in the first place. So help our British companies get contracts with government. Number one, 29 billion, we need access to that. The 2 companies that I saw that have been contracted to Darktrace and Contexa of the new breed. So that's just woeful. And again, that's risk-taking. Our government is, and then the biggest contract that we've just handed over to Google, which is for cloud hosting, it's an enormous contract, and there was no procurement process. Why? Because there was no money exchanging hands, because in return, Google are training 100,000 of our government employees on AI. What? And what data have we given them? So I think there's a lot that could be done very quickly by UK government to be able to make some big differences for young companies here in the UK.
Thank you very much. Listen, I could very happily carry this on for at least another hour or so. We could do an extended sort of podcast version, couldn't we, and then cut it down? But I'm very conscious, Richie, you need to get back on a plane and get over to the US to continue building your business over in the States. I think what we've learned is whether you start in sort of media, philosophy, or accounting, you can still shape the future of tech and innovation in the UK and internationally. So I'd like to say a massive thank you to our 3 panellists for a really fascinating panel discussion.